Okay. Well, good afternoon, everybody. Thank you for joining McQueen Financial Advisors and our webinar today, Investing for Growth and Purpose. Appreciate it. I'm just waiting for a few more registrants to join in and we'll get things rolling along. Okay, looks like we've got plenty of joined in. We'll have them join us in a minute. I want to start off with I'm Craig Cecilia. I'm our Chief Investment Officer here at McQueen Financial. Work on portfolio management as well as our advisory group and looking at credit and working with clients as well, doing interest rate risk management. Joining us today is one of our advisors, Jill Cernojevic. And Jill is also specializes in portfolio management as well as interest rate risk management and consulting with management as well as boards. She's been in the banking industry for over 15 years, and she really does appreciate working with boards and on strategy, on portfolio optimization, balance sheet management, as well as on CECL matters as well. Jill, thanks for joining us today.
No problem. Thanks for having me, Craig. You're showing my age there, so thank you.
You're welcome. Well, at least you don't have that gray top like me. As somebody has said, a white top nowadays. A few administrative topics here is at the top or bottom of your screen, depending on how you have the webinar set up with your Zoom, there is a Q&A button there you can use throughout the webinar. We'll be monitoring that and answering questions as appropriate throughout, and some we may save for the remainder or at the end. There's also a chat function in there as well. Also, we're going to have this recorded. We'll put it up to our website, and if you do want a copy of it, if you can't get to our navigator or our website, please just reach out to your advisor and they can easily just send it on over to you as well. So without any pause, we're going to go over kind of the agenda here.
Absolutely. I'm going to take it from here, Craig, for today's overview of our webinar. So we're going to do a quick economic update, just what's been going on the past few weeks. And, there's been a lot of volatility in the market, just a quick update on that. Then we want to get into the basics of set our parameters, what we're going to be talking about today within portfolios. Then obviously we want to get into portfolio strategies. That's what we're here for, growth and strategies. We're going to talk a little bit about asset diversification and getting into some different asset classes and talking briefly about those. We're also going to be talking about managing risk. So managing risk within the portfolio is huge as well, to be able to do the things that we want to do every day with it. Managing that policy as well is also helping managing that risk. We're going to get into a little bit of that, and also some purchasing or some trading tips. Next we can get into our economic update right off the bat. So this was printed as of early morning on Monday, yesterday. Today's Tuesday. So we can see that 10-year Treasury as of Monday morning was at 3.99. Currently this afternoon when I looked at it, it was up to 4.20%. So we can just see that again, 20 or 21 basis points. There's been a lot of volatility within the market within the past few weeks. A lot of that is due to tariffs, upcoming tariff talks. We know we had that Liberation Day. Tariffs have been in place now. They've been in place now for a few days, right? A few weeks. So we are still waiting for a lot of those data points to come in to see how that's going to affect the economy long term as well. So
yeah, Jill, I'm hearing a lot of chatter about these tariffs, and from what I'm understanding, there's not a 100% certainty on every tariff and how they're going to be impacting U.S. and our industry, but also, is it going to be 30%? Is it going to be double? Is it going to be 10%? There's still a lot up in the air, right?
there is, absolutely, exactly. And a lot of that uncertainty is causing a lot of that volatility within the market because there's that uncertainty out there.
Yeah. Absolutely.
Hmm. And on the next chart, we can see that we are looking at rates to potentially still trend downward. But I thought this one has a good illustration of when rates tend to come down, we can see that there's still some of that volatility, or it's not like a straight shot down. It's a little bit of that jaggedness down. So we can see here in that 26, 27, 28 era, last time rates kind of fell naturally. We can see there was some of that volatility in that time frame as well. So it didn't just kind of rates didn't just kind of tumble straight down. There was some of that volatility, some of that jaggedness on that way down as well. It's what we're experiencing now.
Yeah. And kind of where we're sitting right now is the big question here on the right-hand side here. Hopefully you can see that beautiful drawing that I have there is what's going to happen with the Fed? Are they going to lower rates? Are they going to raise rates or just sit on their hands for a bit? Do we have a good insight into that yet?
We do have a good insight into that yet. Actually, if you want to carry it over to the next page.
Ah, okay.
Ah, right. I know.
Yeah. I have to unannotate and hit the page forward for you.
You're good. So we can see what the market is calling for in terms of rate reductions for the upcoming. So we can see there on the target rate that they are looking for numbering them. I'm going to count them 1, 2, 3, 4, 5 or so rate cuts are priced in right now until the end of 2027. I still feel that is a little bit ambitious. Being so, again, everything is just very uncertainty, very, very volatile right now. I still see overall about, I'd say, two cuts coming in, one sometime in the end of the summer, towards the summer, one potentially coming in towards the end of the year, but everything is going to be very data dependent going forward.
Gotcha. And as I look down the middle of that chart there, Jill, it looks like December on the upper bound seems to be about 3.5.
Yeah,
Gotcha. And just hold your breath and it may change, right?
absolutely. Yes. Like I said, lots of uncertainty, lots of volatility out there.
Yeah, I agree. I agree.
Yeah.
All right. Well, I want to get into just really briefly, just to give the audience a little bit of flavor here, is we have a little bit of a repeat on some of the basics of our investments 101, but we're going to talk a little bit differently this time. And just a really brief introduction into the basics for a few of the people that aren't necessarily in a complete role of managing portfolios, but want to talk a little bit about what some of the portfolio types we have and what type of bond we have here.
Yeah.
And right, so
Absolutely.
typically we're going into types. We have a regular standard portfolio, is right?
Hmm. Yeah, we have different types as well. So today we're mostly going to be talking about our standard investment portfolio. We also have the EBPA portfolio, the employee benefits pre-funding account. We also have our CDA, which are charitable donation account. Those accounts we do have different webinars on. Please go to YouTube on the McQueen channel and check those out. We're going to be just talking about the standard investment portfolio today.
Yeah. Okay. Thank you, Joe.
Yeah,
And most of the composition of these standard portfolios for banks and credit unions consist of fixed income securities or variable rate securities, but bonds.
correct.
And typically, what a bond would be is an issuer, and that issuer is guaranteeing the payment of the timely principal and interest. And those can come in the form of a municipal bond, a corporate bond, agency security, mortgage-backed security,
Treasuries, exactly.
treasuries, absolutely. And so you can buy them, and you buy them in par. So, for an example, if you have a $500,000 to put into the portfolio, you can go out and buy a $500,000 of a bond or $250,000, and that's what they call as par. And the issuer issues these securities with the promise to pay you periodic interest payments. Could be monthly, could be semi-annual, could be annual, or if a treasury bill, it could be interest at maturity. But ultimately, there's a guarantee or by the issuer. In life, there's not a lot of guarantees, but a commitment from the issuer, we'll put it that way, to pay you interest on your investment. And then the maturity comes along and they'll pay you back your principal over. Now, the exception to that is a mortgage-backed security where you have an amortizement on a monthly basis basis, and your principal comes back to you over several periods. So that's kind of what we're going to be talking about today is all the variety of bonds that can be within a portfolio for you for these investments. Now, as we get into strategy,
Yeah, we're going to be talking about a few different things about strategy today. So, thank you, Craig, for the explanation or the 101 explanation of why we have the investment portfolio and kind of what goes into it. Now, again, we want to talk about why we have that investment portfolio. We know what goes into it, so what are we going to do with it? One of the things we can use it for is funding our lending, right? As financial institutions, we know one of our huge sources of income is lending. So we want to be able to lend out to our members and our clients and our customers that we can. Because one, obviously, it brings income to us. Two, it also helps our community and helps our neighbors and helps our members. So liquidity reasons, we also want to have that investment portfolio for liquidity. As I just said, it kind of ties with lending, but we want to make sure we have the liquidity and our cash needs to be able to meet our members and our customers' needs. On top of our needs as well, right? And be able to do everything that we want to do. Ties into cash flow as well. We can manage some of those assets and liabilities within ALM and use the portfolio to tie into some of that with managing our cash flow. So we can have that consistent cash flow instead of having some of that jaggedness, right? Also using it for income. So obviously we have our loan portfolio and our lending, but we can also use our investment portfolio for income, right? Gaining some of that yield, being able to put some of that on the books when we can. Some institutions also use their investment portfolio as a minimum percentage of assets. Typically, I don't see that a lot, but when I do see it, it is usually somewhere in the 2 to 5% range of minimum percent of assets. Another strategy we will get into is lost harvesting. So in order to be able to potentially sell some of those losses at the end of the year and harvest some of those gains. And also cleaning up some tails. So if, as Craig said, if you're looking at an amortized product such as a mortgage-backed security, as it amortizes down, you could have a potential very small principal left. Instead of waiting for that to run off, we can potentially sell that and sell that and get rid of it and reinvest that money into something else. So Craig's going to get into a few different more of those portfolio strategies a little bit more in depth as well.
Yep, absolutely. And I do like one of the things that really do get overlooked sometimes is that very last bullet point, Jill, is cleanup tails.
Yeah.
Because you could have in an amortizing security, as you mentioned, could have a small par of, $4,000 left outstanding and your custody costs and your accounting administrative costs to keep up on that stuff sometimes eats away completely at your actual earnings off of that bond, even if it's a 4% rate of return. So it's very interesting to pay attention to that. And we'll talk about, how often do these portfolios get looked at for a strategic standpoint to make sure that all of this is being analyzed.
Yeah, absolutely.
Great introduction. So this is a very interesting screen, and I don't think it's going to be new to anybody with respect to what the data is showing. But what it is unrealized gains and losses since 2006 on bank balance sheets. The reason that we're using it is very easy information to extract away from the FDIC. And you can see in 2006, there was just a very minimal amount of unrealized gain losses in the industry. Super small, immaterial. And it kind of got a little more volatile as we went into the great financial crisis. And then we entered into that low rate environment that, basically lasted forever, it seemed like. But there was unrealized gains on the balance sheet when Fed funds were, at a 0 to 25 basis point range. Your 10-year it was, sub 1% to 2%. And things looked really good and like they weren't going anywhere for a long period of time. Then enter in the period when you get all of a sudden you have the COVID crash, right? And rates were going up for a little bit. COVID hit and rates dropped like a rock again. And all of a sudden unrealized gains came. And now we enter into post-COVID. Rates are going up and you can see all these unrealized losses on all balance sheets. And it's interesting as you look at tailing from beginning of 23 into the end of 24, your losses have been slowly going down. And one, there's a little bit of volatility of interest rates, but two, it's what actually was being actionable, actions being taken place by institutions in the marketplace. They basically were looking at what are my losses? How do I manage this? And how can I better turn this investment into an earning asset that one eliminates my unrealized loss, but increase my overall earnings? And it gets into something that you said earlier, Jill, was, you mentioned a tax harvesting. There's also just kind of the swapping out, booking a loss, offsetting it with some potential gains on sales, or just actually just taking a hit to capital or net worth if you can, and reinvesting into the marketplace. And so this is interesting, and a lot of institutions have been doing this for the last 2 years. And that's one of the strategies we want to kind of talk about. As we go through, this is an interesting chart as well. This is the percentage of banks that actually realize security losses by quarter. And we'll just focus in 2024 because there's a lot of data here. And really the big trend for an increase started in, say, call it 2022, and then end of 22 into 23 was big, and even 24 is happening. But you can see, on average, in 2024, anywhere from 9 to 18% of institutions were selling off securities that are underwater or taking and monetizing those unrealized losses. And that's a big number. Um, what were they doing with these? They were lending out the money. They were reinvesting into the securities marketplace. They were paying off some advances, but basically managing their balance sheet. And the reason that we want to talk about this a little bit, because as we work with clients and just non-clients and prospects, we see a lot of this happening. But there's still a big group out there that's just saying, listen, I'm a buy and hold institution, and I don't want to impact or report to my management or report to my board of, hey, we made a mistake a few years ago. We're just going to sell things because they're underwater to help the balance sheet. And I want to make sure that you guys see and understand that it's not necessarily a negative. It's actually a positive if your balance sheet can handle that, to help manage earnings, manage your risks on a go-forward basis. But big amount of institutions that are doing this. This last chart here with respect to unrealized losses goes to has size impacted these institutions? And this is a chart of it's categorized by size, the smaller institutions from the left-hand side all the way to over 275 billion on the right-hand side. So in the small bucket, 500 million and less in assets, just under 22% of those institutions harvested losses in 2024, meaning sold securities at a loss. And for the 500,000 to just under $1 billion, it was just under 29%. I'm going to round it to 29%. Is that fair to do?
Yes, that's definitely fair. Close
Okay.
enough.
Yep. In the 1 to 4 billion, 32% of the institutions in the 1 to 4 billion dollar range, so a third, 32% of them took losses in 2024 for various reasons. So again, a big balance sheet analysis taking place, reinvesting into the marketplace, either through lending or in the investment securities. I wish I had included it, but if you looked at the actual interest rate return in the investment portfolios as time went on, it's been coming up. Some just actual cash rolling off and investing in the marketplace, but some for deliberate get loss on sale and reinvesting in the marketplace, returns increasing as well. And just really interesting, over 275 billion, 100% of them had some kind of security sale that ended up in a loss in 2024. So that's 100% of the really big guys. So very interesting information there.
Yeah, very interesting. Just tells you all the big guys are doing it. It's something definitely everybody should potentially be looking at.
Right. And traditionally, when you get into community financial institutions, whether it's banks or credit unions, I said this earlier, the word, the buy and hold. And I don't think it's something that necessarily is wrong, but it's definitely something that needs to be looked at and considered to make a strategic type of balance sheet trade or transaction for the benefit of the future. And we got to really make sure that people understand that. And it's not taboo. It's actually good management and Elko management. So we get into portfolio strategies here, just the basics. I like to look at this, Jill, before I hand it off to you, and I always like to say it. I see the SLY principle here, the acronym SLY. You want to
Hmm.
talk about that a little bit?
Absolutely. Yes. So thinking about exactly like you said, the longevity of our institution, we want them to be around for a very, very long time, right? We want to have long-term strategies. So with these strategies, there's a few principles that we always follow, as Craig said, our safety, liquidity, and our yield. So we always want to go to safety first. We want to invest things that are going to be safe for us. So we want to take a look at those risks, looking at the different asset classes, and we'll get into those in a minute. The different risks on all the different asset classes. We want to see if what our principal is and make sure our principal is safe. Any money that we're investing initially, and then also our premium. Right. So are we paying any additional for this bond? Do we have any premium risk there? Next comes liquidity. So once we know that it is safe, we want to look at liquidity next. So we want to take a look at our cash flow. Can this investment fit into our cash flow, and again fit into that fitting into our good cash flow for us, something like that, or looking at a pledge for a line of credits. For example, can it be pledgeable at the FHLB, or can it be pledgeable at the discount window, which would give us our ability to then borrow if needed. So last thing on there is yield. So we want to be very aware of yield, but we don't want to go chasing yield. So we want to look at our yield of our fixed versus our cash option, or our fixed versus our variable option. We know our fixed option, again, versus variable is going to fluctuate with the market. And then our optionality. We want to take a look at our optionality options. Right now, with rates coming down, we want to steer away from that optionality, or callable options, if you will. We want to be able to extend that yield out as long as we can and lock in that yield, instead of having something callable maybe 2 or 3 years into, example, like a 5-year bond. Then we have that reinvestment risk where we have to reinvest at lower rates.
Yeah, I love this page here, Jill, as you kind of walk through these different areas of concern that people should be prioritizing as. And it kind of goes down to interest rate risk management and when you talk about safety, as it makes me think similar, meaning we're not here and our customers and the market's not there to eliminate risk. They gotta manage risk and understand the risk. As we know, most investments in in the marketplace do have risk, especially when we get into credit related product. And we're going to talk a little bit about due diligence and stuff later on. So even though there is risk, it has to be an understandable, quantifiable risk when entering into an investment, and making sure that you do get back what you're expecting to get back and not have any kind of surprises. And I love the liquidity there, because a lot of people will really micromanage holes in their ladder to bring back maturities on a certain quarter, a certain month, or a major CD, large depositor coming off. That certainly should be a consideration as well. But when you build a well-seasoned, cash flowing portfolio, absent of that really ultra large depositor, you should be able to manage those fluctuations and withdrawals from your institution with the right type of ladder in there as well. So,
Absolutely.
yeah.
Yeah, you said it very well. It's about managing that risk. You're never going to be able to eliminate that risk. It's about managing it because it will always be there.
Yeah, yeah, absolutely. And the optionality, it's funny because it goes in cycles. And right now the cycle is, and this is a warning to everybody on the call, this is we are getting inundated with you should buy this callable agency right now, because they had that drop of the 10-year to 4% or 3.99, and it's just they came out of the woodwork as you got to buy this callable because the VIX is high and the spreads are there and you got this extra yield, and it's just amazing. And how do you react to that, Jill?
Well, at first you're a little bit of sticker shock. You look at those, basis points, you say, "Oh, that yield looks really great," right? And then you gotta pause for a minute. You gotta have a pause and then kind of readjust and look at the safety. You got to go back to your principles, your safety, liquidity, and yield. So you don't want to go chasing yield. You want to make sure you look at the safety of that bond first. So, like I said, is it locking in that yield for you long term, or is it going to be callable, have the optionality, and you're going to have to reinvest at lower rates?
Yeah. Yeah. Because when you buy a call bond, you're basically giving the issuer that flexibility, right?
You're putting the control in their hands
The
versus your
control is in
hands.
their hand. And
Yeah,
last I knew, everybody on this call wants to be in control of managing their balance sheet, right?
absolutely.
Yeah. Yeah. So love that you brought that up. Good job.
hmm
Okay.
Yeah, we can get into a little bit of asset class diversification. So we talked a little bit about strategy and what we look at. Now we can talk about what we get into in the portfolio. So again, diversification. So why do we want to diversify asset classes within the portfolio? Obviously, one of them is yield. We'll get into it in just a minute, but all the different asset classes do offer different yields, right? Which they should because they are riskier. So that risk is associated with that yield. Obviously, here just talking about risk profile, as I just said. Obviously, the more yield you can procure is the potentially more risk that it has as well. Also looking at that maturity or average life. So how long is that investment going to be in your portfolio? And the average life of that, how long is it going to be in your portfolio? How is that going to affect your portfolio? And looking at the static or amortized cash flow. So is it a static, predictable cash flow, or are we investing in an amortizing product, again, such as a mortgage-backed security, where that cash flow can change based on payments and interest rates? So next slide here, we get into a little bit of diving deep into them. So looking at our very vanilla ones first, if you will, we get into CDs. We know CDs are your vanilla asset class, if you will. You can get them from institutions, from banks, credit unions, things like that. You usually want to stick up to the insured FDIC or NCUA limit of 250,000. Pretty basic there. Next asset class we would get into is treasuries. Treasuries, they can be in very short term, all the way up to 30-year, very, very long term. With those ones, again, those tend to be a little bit easier to purchase, kind of vanilla. Yields are flow very well with the marketplace. Their treasury yields are the one that we base other asset classes off of for pricing them. So next we have agency bonds. And again, those can be in a bullet or a callable, as we were just talking about, adding in some of that optionality. Typically, right now, we want to look at bullet agency bonds. So again, those are the ones that will have those longer maturity dates and be able to extend that yield out for you without those callable options. Mortgage-backed securities and CMOs. Again, mortgage-backed securities and CMOs, they have that amortizing payment schedule. So those are different payment schedules than your agency bonds or your CDs, where you have your coupon payment on a schedule, and then you get them paid out annually. Your MBS or your CMO are flowing with your payments. So as the mortgage in the mortgage-backed security gets a payment, you're getting your principal and interest payment, and as the payments go. So if there's overpayment, you're getting a little bit more. If they didn't pay that month, right, then you're gonna have a little bit less. So same thing with CMBS, which is your collateralized mortgage-backed securities. That's an amortizing product as well.
Right. All of these have very unique characteristics, Jill, right?
Yes, all
Yeah.
very different.
All very different. And when talking about diversification, which we're gonna have a chart, two charts from now. My favorite chart in this whole slide deck,
We're
by
getting
the
to it.
way.
We're getting to
Oh God, I'm
it.
excited. Chewing my fingernails, just waiting with anticipation. Um, some may seem too plain vanilla. Some may see, wow, this is going to be really hard to manage. But in reality, the diversification of a portfolio should be complementary to everything that's in there. Is that correct?
Absolutely. Yeah. Just thinking about, yeah, I think of like things that you I compare it to things that you eat, right? If you were to eat cookies all day, right, you're going to get a stomach ache and you're going to be sick. You can't eat one nutritional thing. You have to have diversification within your nutrition. You have to have diversification within your asset classes.
So tacos all day is okay though, because there's a mix of food within the taco, right? That's balanced enough.
Tuesdays, yes. Every
Oh,
Tuesday, you're good.
of course. Tequila and tacos. You got
Yep.
it. All right. So continuing on with asset class diversification.
Asset class diversification. These ones on this page add a little bit more scrutiny. These add some credit components to it. So we have corporate bonds that can be purchased from your corporations. Also have banknotes, which can be purchased from your financial institutions. Again, those have credit ratings incorporated with them. So we can see on the side there, I have a little investment grade. We have our S&P and our Moody's and our Fitch, which are our three main credit components, three main credit tiers. So they look at the different credit and they just determine what's investment grade and what's not investment grade. So we can see anything there, triple B or above is considered investment grade, double B or below is our non-investment grade. In our standard portfolios, we always definitely stick to investment grades. We talked about that safety, right? So we always want to stick to investment grade corporates. In some of your other portfolios, your CDAs, your EBPAs, you may want to, since you use less there's definitely less assets in those less funds. You can play around a little bit more with some of those maybe non-investment grades or some of those lower credits. But with the standard investment portfolio, we definitely stick to higher credit tiered corporate bonds. Same thing with municipal bonds. So those can be state, those can be city, district, anything like that. They also have different tax qualifications. So they can be taxable, tax exempt, or BQ, which is bank qualified for our bank purchasers.
Gotcha. Jill, this is actually a great time because a question did roll in, and it
Yeah.
has to do with really this page
Hmm.
specifically, and it has to do with risk weighting.
Okay.
So the question is, if our institution is considering using risk weighting within their portfolio for call reporting, how are the risk weightings difference between the corporates and municipal bonds?
Yeah. No, great question. So corporates are 100% risk weighted, where municipal bonds are a little bit different. So, and then there's GO and revenue bonds as well. So you could drill down even further into these asset classes. But municipal bonds, general obligation or GO bonds are 20%, and revenue bonds are risk weighted at 50%.
Gotcha. Okay. So, and it's not a credit rating risk weighting, meaning a triple A, as you see on the screen, rating weighting. It's more of the type of issuer that it is, and the risk weighting gets assigned to it.
Correct.
Gotcha. Okay.
Hmm.
Thank you.
Yeah.
Hopefully that answers that question well. If not, ping us again, please.
Good question.
Yeah. Okay. Let's turn the page for you. And I took my glasses off so you can tell I turned the wrong way.
Let's say you're getting looking for your favorite one, right?
This is it. This
Yay!
is it.
Very colorful. So this is just to demonstrate again why we have asset class diversification. You can sit here and listen to me talk about it all you want, but I love visuals, right? And I love color. So we can see I just went back 10 years to look at different asset classes and what they've been yielding for the past 10 years. So went back from 2015 all the way to 2024. Here you can see at the top is our higher yielding asset classes. And those are the ones that typically involve a little bit more risk, right? Our taxable munis and our corporates that we have to, again, they could be potentially a little bit more risky. Again, looking at 2015, we can see we have our MBS, our agency bullets, our treasuries, and our CDs. So back, 10-ish years ago, CDs, we can see they were paying, 3 basis points, something not too great. We can see all of our other different asset classes there. As we travel through time, let's move up to 2022, or excuse me, 2020. We can see that a little bit of shift is changing, right? Treasury CDs are a little bit more than treasuries, and we can see some of that shift in asset classes. Let's travel all the way down back to 2024, last year. You can see there's a huge shift in asset classes, right? So CDs, which were at the bottom previously, are now at near the top. Based on liquidity needs, based on lending needs, based on the economy, everything that kind of changes, you can see, like I said, all the different shifts in these asset classes. So if you were investing only in one of these asset classes, yes, you would still be earning yield. Yes, you would still be, having a good portfolio, but you would be missing opportunity, as you can see that yield does change and shift.
Yeah. One of the things I love looking at, and this is by far, I think we referred to it as a quilt before with the
I like a
colors,
quilt, yeah.
patchwork. It's wonderful. But
Hmm.
kind of looking at that 21 to 22 to 23 and 4, I kind of look at this and correlate it to what was going on in the economy.
Yeah, absolutely.
Right.
Hmm.
So going into 22, we had a shift of interest rates, and the markets were moving quicker than, say, liquidity on our financial institutions' balance sheets. So the market-driven stuff, the treasuries and agencies kind of took precedence as the highest yield out there. But then we all know that there was a lot of liquidity that was needed in 23. It kind of dried up, and institutions were looking at the wholesale market, home loan bank and stuff. And so all of a sudden you see that shift where CDs popped up so much, right? That whole liquidity event that took place. And now in 24, things settled down a little bit and we got that transition again. And I also love to see, take a look at the green where it's kind of trending along the bottom, right?
Hmm.
Um, so I wouldn't call it a halibut, right? Halibut, kind of swims along the bottom there, kind of
Catfish.
flat guy, half fish. Yeah, right. Half pancake. But yeah, so treasuries, there's a time and a place, but often there's not a time and a place, right? If you really have a good diversified looking if with quality credit product and enhancing your yield. So it's just wonderful to look at this. And I love the diversification conversation on this, how it's good to have a lot of different things in there because the whole myth of this is our strategy and we should stick to it, it should shift a little,
Yeah.
over time, depending on what's happening to the market, not always be that just buying agencies and mortgages or just buying munis and CDs. It just should change over time and be proactively looking at that. This is, again, favorite chart. Really well done with this, Joe.
Thank you. Yeah, and
Yeah,
exactly. Just because we've always been doing it that way doesn't mean we always need to continue to do it that way. Are we missing out? Are we missing opportunities?
right on.
Yeah.
All right, so we want to do transition a little bit into risk. And again, we're not in the business, and nobody on this call is in the business of completely eliminating risk, right? We're in the we're in the business of managing risk. Here's a variety of different types of risks that exist when considering your investment portfolio and your balance sheet. And the number one risk would be credit, right? It's a hard day when someone invests in something. It's just like a loan. The day you invest in it, the day you lend that money, it's a good loan and it's a good investment. But
No.
we know time changes some things, economic cycles change some things. And when you're entering into an investment, especially when it's credit related, taxable munis, tax exempt munis, corporate bonds, if you're into private label CMOs that, involves credit, asset-backed securities, all of those should have a very well-defined, deliberate process to understand that credit. And I know we're going to talk a little bit about policy and components, which is going to consider that and dictate things, but credit risk is A1, very important, excuse me, to determine should I be getting into this? What's the probability of me getting back my principal and interest as expected when entering into this investment? The other thing is interest rate risk. We saw some bank failures that didn't it had as I won't quote who it was, but a colossal failure of ALM management, right? Interest rate risk, and making sure that you're managing your investment portfolio as a complementary tool to the rest of your balance sheet, really making sure that you understand the risk, the extension risk, the convexity. Jill, you mentioned about optionality with callable bonds, and there's also optionality in the mortgage related market, whether it's CMBS or CMOs or pass throughs, to name a few. Understanding that risk and modeling it is super important because it really could leave you in a really bad day or a really good day when you are entering and going through economic cycles and interest rate cycles. Your income risk, as we always could say, if you get into some variable rate stuff, right? Rates going down, going up. You do have income risk when managing your investment portfolio, and you have to understand your yield should be the last component you're considering when you're managing your portfolio. Safety, liquidity, what are we trying to accomplish? What's our strategy? How are we going to do it? Can we make some money at doing this? Does it make sense? Or should we leave it in cash? And then your liquidity. All right. So you mentioned something with respect to a strategy and what you have a portfolio for. What is the objective of the portfolio? And sometimes it's for collateral, right? And collateral meaning you can either have to pledge it to let's call it a municipal deposit or a repo account or Federal Home Loan Bank. That's one way of thinking about liquidity. Another way of thinking about liquidity is the investment I'm entering into truly a highly liquid security in the event I want to or need to exit out of this investment prior to maturity? And when you get into, say, some different unique characteristic bonds, they, with a little bit of hiccup in the economy, the bid on the market or the buyers that make markets in this, they do go away. They can say, hey, buy this bond today because we make markets in them and we'll support the market. But there's no guarantees in that with a change in the economy, change in liquidity, change in earnings on that institution or in general. That liquidity of that security can go away really quickly. So when Jill talking about diversification, you want to make sure you have a good percentage of highly liquid securities that, regardless of the economic cycle, there'll be a good solid bid, meaning there's not a big spread between where you could buy and sell it in the marketplace. Does that make sense?
Yeah, absolutely.
Sometimes I sometimes get a little wordy. I might get lost in as I use too many words, right?
I
I get
got you. You're good.
Thank you. Just shut me down if you need to be. So I love the reputation one. And this is like a lot of eyebrows raise when you say reputation with your investment portfolio. And we'll talk about a few things with reputation. One is the obvious. You want to support your communities. You want to, in the banks, there's a lot of the banks that are on here, they get sometimes, depending on the type of municipal bond, they can get CRA credit for that. Credit unions can do the same thing. I guess there is rumors about CRA for larger credit unions coming down the tubes, by the way.
Hmm.
Don't know if that's going to come to fruition or not. I'm hoping there's going to be deregulation and not more, but we'll see what happens with that. But yeah, the credit unions can support local communities just like banks can support local communities. If there's a township, a library needs to issue some debt, and just kind of supporting the economic development of your communities that you're banking in is a great thing.
Hmm.
Taking another approach, you might have a very distinctive type of institution that doesn't want to support different industries. For example, there's some that don't want to support the tobacco industry or or alcohol or firearms or you name it. There could be any kind of reason, and some of the people would realize, well, if something happens, because this is considered a industry that can be helpful or harmful depending on how you look at. But if there's something really negative that happens to that industry and I'm investing in it, I could be looked upon as negatively as an institution to supporting that industry. And I get it. I understand that. And those are some things that people might want to consider when going into but I really do like supporting your communities whenever possible when you can through your investment portfolio and doing that, especially if there might be some low income housing or low income opportunities there just to really help.
Hmm.
So, and then the other thing is managing your risk is just overall general market risk that when we started talking about the unrealized losses on institutions over time and what economic cycle we are in and the amount of unrealized losses based on interest rate risks, you will have market risk in your portfolio naturally. So when constructing your portfolio, you want to make sure that you manage that investments portfolio to match the rest of your balance sheet so it works in unison. So if rates go up, you don't have too much risk. Even if you do have unrealized losses, you still have plenty of liquidity, plenty of capital where you don't have to be liquidating and you're still in a good position to continue to operate. And then if rates go down, the same. You don't want rates go down and you have a portfolio that's constructed where all of a sudden your investments come back to you because of negative convexity or optionality. But at the same time, all of your loans are prepaying to you because people are refinancing or either with you or going off to another institution to get a lower borrowing rate. All of a sudden, you're flush liquidity, and where are interest rates? They're really low. So it's again, that whole market risk does impact and making sure you manage that balance sheet. So market risk does not enter into managing your balance sheet inappropriately. And then market risk can also go into liquidity of your investments as well. But we kind of talked a little bit about that during liquidity as well.
Yeah, you want it to complement, right? You don't want it to clash. Definitely want it to complement.
Yeah, absolutely. So I want to introduce this next section because a lot of people said, hey, this is going to be a very boring section of our presentation today, which I totally disagree with that, by the way. This is exciting part. But we talked about, harvesting losses out of a portfolio.
Hmm.
And that's very impactful. That means that needs to be reported. That needs to be talked about internally, brought to the board. We're thinking about taking some of these material losses. We talked about asset diversification and some things that we may be approved and doesn't necessarily get done a lot. And so I want to get into this next section, Jill, about policy and some
Hmm.
things that people should be thinking about when thinking about their policy. Why is it important to really be able to maximize your portfolio's performance through making sure the tool of your policy is there to help you?
Yeah, no, absolutely. Great introduction. And your policy is your framework for what you can do with your investment portfolio, right? It sets your boundaries or your yard in order to be able to what areas can you play in, right? So if you want to flip to the next page or next slide there for policy, thank you. So we know that the investment policy is traditionally written by by management and then approved by the board. So we know the board is the overall responsibility for the policy, and then management is the one that kind of carries it out day to day. We have policy, we want to make sure we have our purpose and our objective in there. So exactly what we just talked about. What's the purpose of our investment portfolio? And again, what are some of our objectives? Obviously, are we looking for cash flow? Are we looking for liquidity? Things like that. Corporate governance on who has the managerial authority to sell things out of the portfolio, to purchase things out of the portfolio. So who is able to make those decisions? Delegation of authority to a third party. So example, if you're using McQueen Financial, right, you can delegate some of those authorities to McQueen. We work with you and do all of that. Authorization or unauthorized asset classes. So in the policy, we also want it to be very clear about what we can invest in and what we cannot invest in. We don't necessarily want a lot of ambiguity there. We want it to be very clear. We also want to put in there limits for each asset class. So again, with each asset class, we can put limits per asset class. We can put limits within the portfolio. We can put limits as far as asset sizes, all of that. We also want to include any approved broker dealer lists. So any broker dealers that we deal with, we want to make sure that they are approved. We want to run our due diligence on them. We want to put that in the policy. Also, again, the broker dealer selection and approval policy, and then also any pre-purchase analysis. So what are we looking at? What are the specifications and what are we looking at when we're looking to purchase things for the investment portfolio? Within the policy, we also want to address risks. So I know Craig talked a lot about risks, the different risks that can come into our portfolio. We want to make sure we address all those risks within the policy as well. So we want to talk about interest rate risk, set some limits on there again. What limitations are we willing to take as far as changes within our interest rate risk? Our liquidity and marketability. Again, what type of asset classes do we want to get into? What type of marketability are there? We would also get into concentration risks. So again, having all of our concentration in one asset class, right, is not the brightest idea. We can definitely diversify and look at definitely those different concentrations. Call risk, as we talk about optionality, we want to look and see if there's some of that call risk and putting that control in other people's hands versus our portfolio. We want to keep it in our hands. Prepayment and extension risk. Again, some of those different asset classes can prepay early or they have the extension risk, such as mortgage-backed securities. We know in low interest rate environments, your mortgage-backed securities are extending quite a bit. So they're staying on your books for longer than maybe you had anticipated. Or as Craig said, in prepayment risks, right? Rates come down, everybody's prepaying right away. And then also credit risks. So looking at the credit risks of the different corporations or municipalities that you're investing in. Last slide on policy. I'm almost done.
I love it.
I know it's everybody's favorites. So procedures within the policy, we also want to have procedures for holdings that fall out of policy. We know everything that we are going to purchase is going to be in policy at that time, but as we said, things shift and change, and market changes and credit changes, and things that we are holding now may fall out of policy in the future. So we want to have a policy set in place for what we do with those bonds that fall out of policy. Also, if we have any conflicts of interest, we want to address that in the policy. Safekeeping, we want to make sure we have all of our appropriate safekeepers, list them out in the policy so we know where they are. Also, the classifications of securities. So that is a whole conversation as well, but into the classifications, we want to make them either available for sale so we can sell and trade them as needed, or HTM, held to maturity. That is where you're going to purchase something. Your intention is to hold it again to maturity, as it says. And then trading, which is actually prohibited by most institutions.
Gotcha. Lots of stuff to be covering on the policy there, Jill. And it's all
Lots of important things. Absolutely. Yes.
yeah. So one question did come in on policy,
Yeah.
and it said, how often should we be changing or reviewing our policy?
Oh, great question. So you should be changing or reviewing your policy at least annually. You want to bring it before the board annually, review it, see if there are any changes that need to be made, and then you want to put that new date on there as well. So you want to review that policy annually.
Excellent.
Yes.
Thank you, Jill.
Yeah, great question.
You're welcome. Oh, I didn't ask it, but you're welcome for presenting it to
I
you.
gotcha.
All right, so I'm going to cover quickly is purchasing
Yep.
because it's extremely important when looking at this and how purchasing kind of works and things to be just worried about and concerned about. There's a primary market and a secondary market when looking at when looking at investments, and primary means they're bringing a bond issuance to the market for the very first time. So it could be an agency issuing a new debt today. It could be your local municipality that's issuing a that got approved in the fall for a debt issuance that's now coming to market in the new year for construction of a new library or capital improvements for a downtown for an EDC, Economic Development Corporation, or something like that. That's a new issue. And typically a new issue, when you're making a purchase in a new issue, it should not matter who you're buying that bond from. It should not matter who you're buying the bond from. That which means you are getting the same price for that security, or you're paying the same price, excuse me, that you're paying the same price whether you buy it from any one of your approved broker dealers on your list. They may not all be involved in the issuance of a municipal bond, but if there's a couple of them, you should get the same price regardless of where you go to. It's a pretty safe market, actually. And nowadays, the new issue market and the municipals are very well oversubscribed because of so much liquidity in the marketplace.
Yeah.
The secondary market is what it is, meaning it's no longer a new issue and it's trading in the secondary market, and somebody had sold a bond or liquidating a bond, and there is a price differential depending on who you're buying it from. It's meaning that you can go to three different brokers and you're going to get three different prices. And that's 9 out of 10 times that's the case. So you're looking at some institutions that put them on their books and they are just inventorying it for a couple days and then selling it. Others are just flipping it, meaning they're buying it and selling it the same day, buying it from one customer and selling it to another. So ultimately, that secondary market is where you have to be very careful because you can get really a technical word screwed in buying a bond. Here,
Mm.
basically, we see it all the time of people overpaying for bonds, and it's really taking away. It's not seen by the person buying it, but there is ways to figure out how much is the dealers are making on this. So it's got to be very careful.
There's actually a good example of that on the next page.
Oh, well, let's move that over and kind of go towards it. Okay, what's this here?
So we can see here with example, if we were purchasing a $2 million MBS bond, if we got three different prices, right? We have broker one, broker two, broker three. So say this is priced just slightly over par at 100, either 145 cents or 150 cents, right? A nickel difference, not a huge deal. But when you're buying $2 million, it does add up. So we can see what our total cost there would be between broker one, broker two, broker three, without any fees or anything like that. Between broker one and broker three, you would be spending an extra $1,000, right, into the broker's potential pocket, right, when you don't necessarily need to be. So, and that is just on one bond example of one purchase, right? So if you were to add up all of those bond purchases throughout the year, throughout the life of the portfolio, that is a huge difference in price there. And then also on the bottom of that page, just so you can see, when we do print your trade letters and we do print your documentation from us of any trades that we've done for you, we do put those competitive brokers lists on the trade for you so you can see them. So we do list them as broker one, broker two. They would say the name on there. I just put them as broker one, broker two, and you can see what that price is that we got from other brokers as well. So you're
I
not
love,
dealing with just one. Yeah.
yeah, I love you're protecting the innocent or the guilty there by just putting the broker names in
Yeah,
there.
exactly. Yep, exactly.
I love it. Okay, I think documentation's the last segment here as we go in, right?
Yeah, yep, absolutely. And we can fly through this pretty quick. So within documentation, that we would give you again after you make a purchase, we want to get into why this security. So again, and that can be very deep into comparing a corporate bond to a corporate bond. Why are we purchasing this corporate bond over, corporate bond A over corporate bond B? So we would get into the descriptions, the characteristics, all of the definitely details of that bond. If there's any type of call feature on it, what the credit rating is, and what the price of yield. So you're going to get all that on the documentation from us.
Right. And that documentation should be required by institutions' policy, but also your regulators are saying you must have this documentation and follow through with it, especially the credit component, not only rating, but understanding that credit. So very important stuff there.
Yes, absolutely.
Absolutely. So I'm gonna sum up a little bit here,
Hmm.
and I think Jill's gonna give you guys a little bit of homework.
I do,
I
yes.
love it. So it's important to understand that strategies are unique to institutions. And a good example is you can have three different institutions that have a strategy of using a investment ladder, but their ladders are uniquely different. Depending on how dynamic their balance sheet is, what's their cash flow, cash swing dollar amounts, and it's the important thing is to know you need to really look at what your ALCO packet looks like, what your balance sheet risks are, what you need out of your investment portfolio to complement the rest of your earning assets as well as your liability structure, and then create an figure out what your objectives are, and then create your strategy. It should be partially laid out in your investment policy, as Jill mentioned, and it should be talked about with your committee, not just one person sitting around making this up. Um, Diversification is key. I love that heat map that you put together with a quilt with the higher yield investment classes over time. Diversification is important for that reason, for yield and performance, but also for collateral, for liquidity, for market volatility. They all work well together. Your policy we covered very well, and your pre and post purchases. The one thing that we didn't do is the post purchase on the credit. You need to continuously do credit on something. It's not like a loan where you book it and it's done on the retail side. On the retail side, you need to really ongoing review of financial statements to make sure that your original credit's not deteriorating. So that leads into homework.
Yes. So, exactly. Just three quick things you can kind of ask yourself or take 5 minutes today and do a quick check on when was the last time that your portfolio was reviewed. Could be yesterday, could be last week, could be a year ago, right? Just a realistic when was the last time I actually sat down, looked at this, saw what was in it, dug deep into it. Again, and then how are we managing our risk? Because risk, there's always going to be risk. You're never going to not have risk. It's always going to be there. So how are we managing it? And then what is my investment strategy going forward? So looking at, again, where we've kind of been, looking at our portfolio, where it is now, looking at things where we're headed. So what do we want to do going forward? How is this going to complement our balance sheet going forward? So kind of ask yourself those questions, think about the answers to those. Yeah, and really think about it. And if you do have any questions or concerns or something, please reach out to me and let me know. I'm happy to discuss it with you.
Gotcha. Well, Jill, that does wrap us up for the day. We appreciate all of our participants participating today. We do have our next webinar on May 13th at 2 o'clock Eastern. And it's about market trends and the strategies for today based on where we are. A lot of good information taking place, a lot of volatility with the tariffs as you introduced us in the economic side of things. And I think it's going to be absolutely fantastic of taking this investments 101 ish type presentation and taking it to the next level and having some nice, good, solid strategies and what we should be working in or considering. So thank you
Absolutely.
everybody for attending. Remember, we can send off a YouTube video of today's webinar at your request, and it will be posted to our website.